Hi, everyone. I think some people are still filtering in, but I will go ahead and get started. Thanks again for joining us here. This is the last in our tribal webinar series on tax opportunities in the Inflation Reduction Act. My name is Molly Melius, and I'm the director of the Lawyers for a Sustainable Economy initiative here at Stanford, which is putting on these webinars with the help from tax and tribal law experts at the law firm Holland Knight. Before we get started, just want to go over a few of the logistics. This presentation portion is being recorded, but not the Q&A portion at the end. If you do have questions, we're going to save them for the end, but you can submit them at any time using the Q&A feature. We will share out these slides as well as a recording of the presentation after the webinar, and it will be available on our website, which is www.lawyersforsustainability.com. So we have two goals for today. The first is to just provide more general education on the Inflation Reduction Act and a little more details on these trickier issues under the ITC and the PTC. And the second is to provide information for tribes on how to apply for pro bono help, which I will tell you a little bit more about right now. So the Lawyers for a Sustainable Economy initiative is an initiative run here at Stanford that matches green startups, nonprofits, and tribes who are working on sustainability matters with firms in the initiative for pro bono help. We have 17 firms in the initiative and have provided assistance to over 120 entities over the last few years. It started back in 2018 at the Global Climate Action Summit in San Francisco by some of my colleagues here and some of the original firms in the initiative. And we're very excited to be expanding our work into this space with all the extra support. So I'm going to kick it over to Nicole here to introduce her amazing team at Holland Knight.
Hi, everyone. Thanks so much for joining. My name is Nicole Elliott, and I'm joined by my colleagues Amish Shah and Ken Parsons. We are all partners at the law firm of Holland Knight. We have experience both in Native American law as well as energy law. So that is a unique kind of interception and where they will be joining today. We have done a series of webinars so far, but as Molly suggested, this one today here is focused on the investment tax credit, which we call ITC for short, or the production tax credit, or PTC for short. But I'm thrilled that both of my colleagues could join us here today. Together, we, I think, have a pretty good presentation for you. And as suggested, we're gonna, I think, kind of unique to some of the webinars out there, allow a lot of time for your questions. So please, as we go through, populate those questions so that we can get to them at the end. Next slide, please. So as we've covered before in our webinar, the Inflation Reduction Act, or the IRA for short, really, which was passed a year and a month ago, or a year and 2 months ago now, was a really significant piece of legislation, all focused on renewable energy, climate, and it had a lot of incentives, both in the form of direct spending, whether that's kind of direct grants, for example, from the Department of Energy, but also through the tax code by leveraging existing tax incentives and creating entirely new tax incentives. What got us really excited about the IRA, not only because of the sheer investments that were made, but because, at least as it relates to the tax benefits, provided us with a long runway. So we've done a couple webinars on this, but historically, some of these tax incentives that we saw were 2 or 3 years. But this is really not only a significant investment in climate and renewable energy, but a long-term investment. It also focused not only just on kind of renewable energy, climate change, but it also had focuses on disadvantaged communities, had some considerations for onshoring, focused on jobs, focused on labor. So it is a really significant law to unpack here today. And we're really going to bite off only a piece of it for you. As I alluded to, Holland Knight has teamed up with Stanford Law and did a series of these webinars. The first webinar that we held was on August 3rd. It was an overview, kind of just in broad strokes, what the IRA contained in terms of tax incentives. That webinar, like the other webinar that we did on August 28th, is available in recording on Stanford Law School's website. The slides should be available as well as the recording. Today, we kind of complete that series of webinars with doing a deep dive on ITC and PTC. We selected these tax credits to do a deep dive for you all because we thought they might be most relevant to tribal governments and those interested in renewable energy. Next slide, please. So what we'll do today for you in the next hour or so is to give you an overview, even though it's somewhat repetitive of the other webinar we did, an overview of all the tax provisions that were included in the IRA, an overview of direct pay and why, the IRA, by allowing for direct pay, really unleashed these tax benefits, the value of these tax benefits to tribes, and then focus on these two tax credits that we've kind of taken out of all of the various tax credits to focus on today. And again, as I mentioned, really focus on your questions and answers. We've seen a lot of these webinars out there that kind of send information one way, and we'd really like to have a conversation with you all and answer any questions to the best of our ability that we can through the Q&A format. So as I mentioned, we want to kind of just highlight, and I'm going to turn over to Amish for this, kind of highlight the breadth of all of the tax incentives the IRA contained.
Thanks, Nicole. The Inflation Reduction Act isn't necessarily new in terms of making tax credits available to support clean energy investments. As Nicole alluded to before the IRA, there were provisions, there were often short-term provisions, and they've been around for decades. What had happened over time is that the technologies for which the credits were available expanded, and what we saw in the IRA was an even much greater expansion of the technologies for which the credits are available, clean energy investments are available. So, we put these into a few different buckets. The first is incentives for clean energy, that is generally electricity, and that's what we'll spend most of our time talking about today. But in the Q&A portion, happy to take questions on any of these categories. The other categories here are alternative fuels. So these are any sort of a fuel that is a not fossil fuel. And so these include things like ethanol and biodiesel and lots of other clean fuels, including things we may not have even thought of historically that are just new and innovative. There are tax credits for manufacturing. And so this is something that is intended to increase the U.S. supply of clean energy products. So, for example, if you're building a solar farm in the U.S., one of the considerations before is that a lot of the equipment that we need to build a solar farm in the U.S. was being built overseas. And so this incentive is intended to build some or have companies build U.S. manufacturing facilities to build solar panels, batteries, and other clean energy components that are used in U.S. projects. Carbon capture and hydrogen. Carbon capture is a technology that really is growing. We're seeing a lot more of it, and we'll continue to see a lot more of it. But this is taking a facility that may be burning fossil fuels, but then taking the CO2 that would otherwise be released in the atmosphere and pumping it underground or using it for other purposes so that it is stored and it doesn't go into the atmosphere. And similarly, hydrogen, there's been a lot of questions or thoughts over the years about hydrogen really being a great clean energy source, but it's been too expensive generally to construct clean hydrogen facilities, and so now we've got a credit for that as well. Energy efficiency credits, as we see there as well, for buildings to help fund energy efficiency incentives. And then finally, clean transportation. We're obviously seeing a lot of EVs, electric vehicles, out in the market now, and often they're more expensive than their internal combustion counterparts. And so the idea here is to more level a playing field between the cost of EVs and internal combustion vehicles in order to increase the amount of EVs and other clean vehicles that we see out on the roads. So with that, I think we're going to turn and focus back on the clean energy credits. But I think before we go there, we're going to just take a moment to talk about direct pay, and Ken, I think, is going to cover that, because the clean energy credits that we're going to talk about today all are eligible for direct pay.
Yeah, thank you. So for those of you who've joined our previous webinars, this won't be news to you, but we thought it made sense to sort of take a step back and understand and describe what direct pay of tax credits means. So tax credits aren't a new concept, but what the Inflation Reduction Act did was it supercharged them. And one of the ways it did that is it enabled tribal governments and other applicable entities to qualify for them. So in the past, to unlock a tax credit, tribes had to use complicated third-party structures. And now you can get the credit yourself. So you might have heard Treasury talk about this. They talk about elective pay, direct pay, elective pay. We're going to use them interchangeably. They mean the same thing. And that is, you're asking money from the IRS. They're writing you a check for the amount of the credit. So a tax credit is different from a tax deduction. A tax credit is dollar for dollar. So if you have a $100 tax credit, you get that $100 from the IRS. So Treasury, with guidance, created a mechanism by which tax-exempt entities like tribes can collect these tax credits. And it's through filing of a tax return. You don't normally file a tax return. And we got into that in the last webinar. But let's focus a little bit now on what applicable entities are, what can qualify on the next slide for a tax credit. So it's not just tribes, there are other types of tax-exempt entities that qualify. So tribes specifically, there's also subdivisions, agencies, instrumentalities, and ANCs as well. I think some of the questions in this area are going to revolve around what types of businesses of tribes can qualify. And if you know that right now there is also a Treasury consultation project on tribally chartered corporations, so that goes hand in hand with this. What types of guidance is going to come out from Treasury on what types of entities are expected, treated as the same as the tribe for tax purposes? That's going to look very similar to who can claim a direct payment as well. So you may also be aware that the Treasury Tribal Advisory Committee recently formed or restructured a subcommittee on tribal economies, and this issue is also within its purview. So it's going to be really interesting to see, for example, things not covered yet, but could be addressed in future guidance. What about a Section 17 or an LLC? What about a gaming authority? All of these types of questions, I think, are to be determined, but very interesting to think about. Next slide, please.
I think this is me, Ken. So just to recap, the IRA had included lots of tax incentives. Amish walked you through the many of them. Today we're focused on just two of them, so two of the many. And the reason that we think that these are particularly important is because we think they have a lot of applicability to this audience, and are important because they are two of the several that can be directly paid. So when we talk about these tax credits that can be directly paid, what we have to first go through is, how do we qualify for the underlying tax credit? How do we get to be able to claim that? And then on top of that, what we covered in the previous webinar is how to then get directly paid. But we're going to go through section 48, which is where we see the investment tax credit, and also section 45, where we see the production tax credit. And as Amish suggested, the investment tax credit and the production tax credit, they've been around for a while. These are not entirely new, but the IRA did greatly expand them, change kind of their terms, and now on top of that allows them to be directly paid, which is super important. So the investment tax credit at its heart, and maybe as the name suggested, is to incentivize the investment in the production of renewable energy. I think prototypically this is like your solar facility. But it actually is a lot broader than that. On this slide, we have included the many projects that could qualify: solar, wind, geothermal. The IRA also expanded this list. For example, energy storage is now included in the investment tax credit. So even though I kind of prototypically think of this as solar, it is broader than that. And it is focused on getting taxpayers to create these projects, and it is a tax credit basically when it is eligible to be claimed the year that the project is put in service. So it is focused, as we'll see, it contrasted to the production tax credit, focused on the cost of and placed in service date, and that's when the tax credit is eligible. So this is for projects, and we'll get into it in a minute, that constructions begins by 2025. Not to worry, the tax credit changes after that, but think about, again, as in what is your what can your entity invest in to create renewable energy? Next slide, please. So if your project qualifies because it is one of the types in the previous slide, the investment tax credit starts at a 6% credit. So it's 6% of the basis in the property. Similar to how a lot of the tax credits in the IRA worked, there is a base credit and then it gets bumped up in value if certain other conditions are met. And we're going to talk about those in deeper depth. But those are the terms that I have highlighted here in red. But think of the ITC as what is my investment in this project? At the bare minimum, if you qualify, the value is 6%. That value climbs by a multitude of 5 if certain labor conditions are met. And by labor conditions, what we mean is prevailing wage and apprenticeship conditions. So 2 pieces in that labor conditions, but that's a big kind of bonus adder because it goes from a 6% credit to a 30% credit. And in addition, which many of our clients are trying to achieve, is that on top of that 30%, there is the ability to make that number even higher by meeting domestic content requirements, and we'll talk about what those are. Placement in an energy community, and an allocation for a low-income community or on Indian lands. All of those things in that last bulleted can get your credit value higher than 30%. So might be worth looking at in terms of, should we invest in this project? Does this project make sense? But the ability to, as we'll share in a minute, can get your value of your investment tax credit from a base of 6% to a max of 70%. So quite a range, quite a range there, which may be achievable, the higher ranges in certain instances. Next slide. So I think this is, the ITC is probably best illustrated, as many of these credits are, with an example. So here, and we've used this example in a previous webinar, a tribe purchases and places solar panels, again, using our very prototypical investment tax credit project of solar panels to put on its roof. Those solar panels cost the tribe $500,000. As we mentioned, solar is a project that would be eligible for an ITC. The base credit, therefore, is 6% of the cost, or in this case, a tax credit of a value of $30,000. However, if we meet those additional items or those additional, what we sometimes refer to as societal goals that were included in the IRA, if we meet the labor conditions, that credit goes from $30,000 to $150,000. And if you happen to be able to hit all those other requirements, that tax credit and the investment tax credit can get up to 70%. Now, what we didn't show in this example is also that this credit is one that's eligible for direct pay. So in the kind of perfect world scenario, that tax credit of that solar panel could be 70% of the $500,000. And if direct pay is sought, the tribe could basically get a check from the IRS in that amount. So that's why I hope you can see why we're so excited about the investment tax credit and all of the IRA tax credits for this audience, in terms of the ability to really leverage the IRA and make investments in renewable energy. Next slide, please. Oh, I'm sorry, Mish. So contrast the investment tax credit to, in some similar but yet different, production tax credit.
Okay, so on the production tax credit, the PTC is available for a lot of the same technologies for which the ITC is available. And so the way this works is the PTC, as Nicole was alluding to, is a tax credit that's based on the production of electricity. And so you get a tax credit for each kilowatt of electricity that's produced during the first 10 years of operations of the project. So for example, if I have a solar project, when I put online and start generating electricity, I get a credit for each kilowatt hour. And so what we look at is you then have the option, and particularly post-IRA for solar, you have the option of saying, which one's more valuable to me? And so in Nicole's example, she talked about a $500,000 project and taking a 70% ITC on that. You can do the math on that. And you can then take a look at this and say, okay, well, let me estimate what my production will be, determine what I think the tax credit will be. And then because it's over 10 years, you can present value that back and figure out whether or not you're effectively getting more dollars under the PTC or the ITC. And you have a choice between the two. In terms of determining how much of a tax credit you get, again, it's based on how much electricity you produce during the first 10 years of operations. It's the amount of the tax credit is 0.3 cents a kilowatt hour. That's the base amount. So you compare that to the 6% ITC. And then if you meet the same labor conditions that Nicole talked about for the ITC, the same labor conditions apply here, and the tax credit goes up by five times again. So it goes to 1.5 cents. Now that 1.5 cents a kilowatt hour is a historic number, and it's been indexed for inflation over the last few decades. So the current amount is actually 2.5 cents per kilowatt hour, and that'll continue to go up for inflation. Again, just like the ITC, the tax credits go up again if you meet domestic content requirements, which means you have a certain amount of domestic materials, domestically produced materials in the project, or if you build in certain communities referred to as energy communities or low-income communities. In either event, the amount of the tax credit goes up by an additional 10% for each of domestic content, 10% for energy community, and up to 10 or 20% for low income. So the bonus rules there are very similar to the ITC rules that Nicole spoke about. You can take that 2.75 cents and really increase that as well to make it much more valuable over the 10-year tax credit period for these projects. For both the ITC and the PTC, these are the current rules that are in effect as long as construction of the project begins before the end of 2025. And then after that, we'll move to another regime, which we'll talk about in just a moment. The one thing to keep in mind about this current regime is you only have to begin construction by the end of 2020. Before the end of 2024. I think we need to fix the date there. By the end of 2024. And to begin construction is a relatively low bar. And so if you're getting into 2024 and we're thinking about building a project, there are things you can do even if you're not ready to do full-scale development of the project in 2024. And just for those paying attention, the date just in the bottom, we can fix that before it gets sent around, should be if construction begins before 1/1/2025. We can go to the next slide. Okay, so what happens when we get to 2025? As Nicole said, we have long-term extensions of these tax credits. And so these don't go away at the end of 2024. In 2025, we have these technology neutral credits. And to some extent, there should be no impact on something like solar. But the idea here is, Nicole put up a chart before showing all of the technologies for which the tax credits are available, the ITCs are available. And there are specific technologies like solar and wind and geothermal and biomass and things like that. When we get to 2025, there is no list. The only question is it a zero GHG electricity source? In other words, is the production of electricity from the source, does it result in zero greenhouse gas emissions? And if it does, then you can choose between the PTC and the ITC. And again, you can choose between the two, whichever one is more more valuable, you can choose between the two. The rules are otherwise generally the same. The PTC is 0.3 cents. If you don't meet the prevailing wage apprenticeship requirement, 1.5 cents. If you do meet the labor requirements, again, those are indexed for inflation, so they're at the same 2.75 cents, or at least they'll be at the kind of 2.75 cents or greater amount by the time we get to 2025. One big difference here is on the PTC, generally under current rules, we have to sell the power to an unrelated person. So if I go back to Nicole's example of putting solar panels on an administrative building, the PTC is not available in that circumstance if the building itself is using the power and the same person owns both the panels and the building, because the sale isn't to an unrelated person. The power is being used itself. Under the new PTC, you can actually put solar panels on your rooftop, use the power yourself, and still get the tax credit, which is a great development. And then on the ITC, the rules are again generally the same. It has to be a 0 GHG greenhouse gas emission electricity source. So the credits, these credits go through at least 2033 and possibly go on beyond that. So once we get to 2033, there's a 2-year ramp down of the tax credit. But if certain greenhouse gas emissions targets aren't satisfied by then, the credits continue up further than that. And so the great news again is that we know that the credits are available in full for at least the next 11 years or 10 years, and then potentially even beyond that, which is terrific. One of the other things we're thinking about, in a number of projects is, some people or sometimes may already have some projects that they've already developed. And so if you are continuing to upgrade those projects, expand those projects, these new credits are available for those expansions as well. Again, there are a few rules around that, but if you're upgrading or expanding a facility, it's important to think about whether or not you may be able to get the new 45Y or 48E tax credits with respect to that upgrade or expansion.
And just to be really clear, so these tax credits, which they're in the investment tax credit, production tax credit, or then in the future kind of go to these tech neutral but similar credits, they are not limited in scope. This is not a situation where you're competing with others for tax credits. Congress had an estimate of what this would cost, but it's very different. And I get this question a lot, which is why I want to emphasize it. I think there's a long runway here to think about investing in these types of projects. And it is not a competition and where you're competing for kind of a limited pie for these tax credits.
Go to the next. So this is just another example to make sure it's clear how significant these tax credits are. One of the things we've been operating in before the IRA was a scenario where the tax credits were going down. And so the tax credits historically were 30% just as a base rate without any sort of labor conditions or any of these bonuses available. And so historically the credits were 30%, at least on the ITC side, 30%. But the statute provided that the credits were being reduced. And so over time, they were going down to 26%, 22%, and then ultimately 10%. And then when the IRA came along, it changed the rules and increased the tax credit amount. So now we've got a base rate of 6%, as we talked about before. If we meet the labor conditions, it goes up by 5%, so it goes to 30%. And similarly, the PTC goes up by 5%, as we talked about. If you meet the domestic content, that's an additional 10%. If you meet energy community, that's an additional 10%. So that takes you up to potentially 50%. So 30% with labor conditions, additional 10% with domestic content, additional 10% with energy community. And then the last one is this low income communities credit program. And that can be an additional 10 or 20% to get you up to 70% ITC. Now, the one thing to keep in mind on that last one is, Nicole mentioned that for a lot of these tax credits, there is no limit. There is no application process. If you're entitled to it, you can get the tax credit. With the last one, that is one of the few exceptions in the tax code where you have to go to the IRS and you have to request an allocation or the ability to get that tax credit. And so There's guidance that's been provided with respect to trying to get that additional low-income communities program. We're waiting for a portal to open up to allow applications. Hopefully that should open up sometime soon. And then folks can apply and wait to see if they get an allocation to get that additional 10 or 20% bonus.
So what we find really exciting about the tax credits is for the last few years with COVID, with the CARES Act and the American Rescue Plan Act, a lot of money has been pumped into tribal economies that can be used for various purposes, not just responding to COVID, but also for government services and infrastructure. Lots of these things, especially in the government services category, could be projects that are eligible for a tax credit. So you could use federal dollars potentially to build something that qualifies for a tax credit and actually net your tribe money at the end of the day. So that's really exciting to us, because you're building something, you're getting something, or you're producing something with federal dollars or state dollars, and then you're getting a check at the end of the day for up to 70% of that back in your pocket that you can use for other purposes. So I think that that's really exciting. There is a limitation on grants. I think one of the questions asked about this, and we can go into it in more detail later, but generally speaking, you can use the grant money for other for these projects and still get a credit. There is a limitation, but I would say that that's the exception rather than the norm. So yeah, once in a generation opportunity to make these investments. And I think a lot of our clients were already really committed to making energy efficient or climate change related investments. And now you have one more incentive to do that. So really, really great opportunity. Next slide.
So as we mentioned at the outset, we hope that you have your questions prepared, because what we're going to do in a minute is turn off the recording so that you can try to stump the experts, so to speak, on these two tax credits and anything really else in the IRA. But we encourage you to get kind of a full picture, to review the recordings for all of our webinars, which again, first webinar was all about the IRA and kind of tried to give you a flavor of the many tax incentives it included. And the second one was really meant to be a deep dive in direct pay, what's required to actually for tribes to get a check from the IRS. And of course here, we thought that it was worthwhile to go through a deeper dive on the investment tax credit and the production tax credit, two of many of the tax incentives that the IRA contained, because we thought they might be most relevant to this audience. Molly, with that, we go off recording to...
Great. Thanks so much to the whole Holland Knight team. That was amazing. I definitely learned a lot during this series, and I hope everybody else did too. So for those who still have questions that weren't answered today, as Nicole said, you can reach out to them. But if others also need direct pro bono assistance as you're going through this process and trying to figure out these credits, please do apply on the lawyersforsustainability.com website. And I want to take you through the process about how that works. So it's pretty simple. Step one here, you fill out the form, and then we follow up with you after that to determine eligibility, to understand a little bit more about your legal needs, and then to try to connect you with a firm in the initiative. If we are able to connect you with a firm, they'll talk with you a little bit more about your needs and make sure that you're eligible for the pro bono. You know, ultimately, it's up to each firm to determine who fits within their pro bono criteria. And then if that works out, then you would sign an engagement with them that describes the scope of the work, and you would move forward from there. That we have a lot more details about the process and about the eligibility here on our website. Oops, went one too far. So I just wanted to thank everyone again. Thanks for the great questions today and on the last webinar. Also wanted to thank all the firms here in the initiative who help provide some of the pro bono support in the background when we do get applications in. And we have one more webinar, not specific to tribes, but for early stage entrepreneurs. So some, Nicole had that last question about what for-profit companies are eligible for and how that works. So if you're interested in hearing a little bit more about that, that will be this Wednesday morning at 9 a.m. Pacific, noon Eastern time, with some attorneys from Wilson Sonsini. So with that, I think we're ready to sign off, but thanks again, and we will send out the recording and the slides. Thank you all. Bye.